Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Dividend Growth Investing, your guide to building wealth. Payout ratio. The payout ratio is a critical indicator of sustainability. It tells investors what portion of earnings a company pays out as dividends. To find it, divide the annual dividends by the company's earnings per share, EPS. For example, if a company has an EPS of $5 and pays out $2 in dividends, the payout ratio would be 40%, $2 divided by $5. A lower payout ratio often suggests that the company has room to grow dividends. But be careful, too low a ratio might indicate that the company isn't returning enough to shareholders. On the flip side, a ratio above 70% could raise red flags. It can suggest that a company is distributing most of its earnings, leaving less for reinvestment or to cover future expenses. A balanced payout ratio typically falls between 40% and 60%, indicating a healthy balance between rewarding shareholders and retaining profits for growth. By focusing on these key metrics, dividend yield, growth rate, and payout ratio, you can make informed choices in your dividend growth investing journey. Which metric resonates most with your investing style? How to build a dividend growth portfolio. Building a dividend growth portfolio takes careful planning and consideration. The goal is to create a set of investments that not only offers regular income through dividends but also has the potential to grow over time. Let's dive into essential steps for constructing a robust portfolio. Selecting stocks. Choosing the right stocks is critical to your success. Start by establishing a solid set of criteria for evaluating potential investments. Here are key factors to consider: financial health. Review a company's balance sheet, income statement, and cash flow. Strong financials show stability and the ability to pay dividends. Look for companies with low debt levels and consistent revenue growth. Dividend history. Investigate how long the company has paid dividends and whether they have a track record of increasing them. Companies with a consistent history signal reliability. Industry position. Consider the company's standing within its industry. Those with a competitive edge are more likely to sustain dividend payments. Valuation metrics. Analyze valuation ratios, such as the price-to-earnings (P/E) ratio. A high P/E might suggest that the stock is overvalued, while a low P/E could indicate a potential bargain. Economic moat. Assess whether the company has a competitive advantage that protects it from competitors. A strong economic moat often translates to better sustainability for dividend payments. By focusing on these criteria, you can build a portfolio of stocks that not only pay dividends but also have the potential for growth. Diversification strategies. Diversification is a vital part of risk management in any investment strategy. When it comes to dividend growth investing, spreading your investments across various sectors and industries can shield your portfolio from volatility. Here's how to achieve effective diversification. Sector allocation. Don't put all your eggs in one basket. Invest in different sectors, such as technology, healthcare, utilities, and consumer goods. This approach balances risks and leverages opportunities across the market. Geographic diversity. Consider including both domestic and international stocks. This can buffer your portfolio against risks specific to one country or region. Market capitalization. Invest in a mix of large cap, mid cap, and small cap stocks. Each has its own risk-return profile. Large cap stocks tend to be more stable, while mid and small cap stocks often offer higher growth potential. Dividend yield versus growth. Balance your portfolio between high-yield stocks and those with a lower yield but higher growth rates. This strategy helps maintain a steady income while allowing for capital appreciation. With these strategies, you can build a diversified portfolio that allows for income generation and risk management. Reinvesting dividends. Reinvesting dividends can significantly enhance your portfolio's growth potential. This strategy involves using your earned dividends to buy more shares rather than cashing them out. Here's why it's a smart move. Compounding effect. When you reinvest dividends, you purchase additional shares. Over time, this can result in exponential growth. Picture your earnings growing on top of each other like a snowball rolling downhill. Mitigating market fluctuations. Reinvestment can buffer against market downturns. During a bear market, buying shares at lower prices can set you up for greater gains when the market recovers. Increased cash flow. As you accumulate more shares, your dividend payments increase. This can create a virtuous cycle where your cash flow grows steadily without additional investments. By reinvesting dividends, you empower your portfolio to grow continuously, creating a powerful tool for wealth accumulation. In summary, building a dividend growth portfolio involves careful stock selection, strategic diversification, and the smart reinvestment of dividends. This approach sets the stage for achieving long-term financial success while enjoying the benefits of regular income. Are you ready to start building your portfolio today? Common mistakes to avoid. When it comes to dividend growth investing, avoiding common pitfalls can be just as crucial as finding the right stocks. While this strategy has the potential to build wealth, a few missteps can derail your progress. Let's examine key mistakes to steer clear of. Chasing high yields. High-yield stocks can seem attractive at first glance. Who wouldn't want hefty return? However, investing solely based on high yields can be risky. Risks of financial instability. A stock with an unusually high dividend yield might be a red flag. If the yield is significantly higher than its peers, it could signal that the company is struggling. Falling stock prices often lead to higher yields, which might indicate underlying issues. Unsustainable dividends. Companies that pay out more in dividends than they earn can't sustain that pattern forever. Eventually, they may cut or eliminate dividends, leaving investors in a lurch. It's important to look beyond yields and assess the company's financial health and dividend history. Before diving into high-yield investments, perform thorough analysis. Are these companies stable? Do they have a reliable track record? Ensure you fully understand what you're getting into. Neglecting diversification. Putting all your money into a handful of dividend stocks can feel tempting, especially if you think you found winners. However, overconcentration poses serious risks. Sector risks. If your investments are heavily weighted in one sector, like energy or technology, you expose yourself to market fluctuations within that sector. Economic downturns or industry-specific challenges can negatively impact your entire portfolio. Opportunity cost. Focusing on just a few stocks means you're missing out on potentially lucrative opportunities in other sectors. Diversification can spread risk and enhance your chances of steady income. Aim for a well-rounded portfolio. Include stocks from various sectors and industries to better weather market storms and tap into growth opportunities across the board. Ignoring financial health of companies. Understanding the financial stability of companies you're investing in is non-negotiable. Neglecting this can lead to poor investment decisions. Analyzing balance sheets. Take a close look at balance sheets and income statements. Strong financials often indicate a company's ability to maintain and grow dividends. Look for healthy cash flows and manageable levels of debt. Dividend consistency. Companies that have a history of paying and increasing dividends signal stability and commitment to shareholders. Don't just look at the current dividend, investigate past performance and future projections. Make it a habit to assess the financial health of potential investments. A few minutes on this can save you from poor choices that may hurt your portfolio in the long run. By avoiding these common mistakes, chasing high yields, neglecting diversification, and ignoring financial health, you can position yourself for more success with dividend growth investing. Are you ready to refine your strategy? Real-life examples of successful dividend growth investing. Understanding how real companies implement dividend growth strategies can provide valuable insights into your own investment approach. Two iconic examples stand out in the field of dividend growth investing: Johnson & Johnson and Procter & Gamble. Their histories of consistent dividend payments can help you see how this strategy plays out in the real world. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.